had some coins on my desk here, and I've got 1881, I think, silver dollar. And I calculated how much it's worth now with the price of, let's say, take $90 silver. I know we're a little bit below there, but $90 silver, that's worth 65 fiat dollars. Do you really think that's going to go back to being like one fiat dollar? I don't. If anything, next year when I'm speaking with you, that's going to be worth maybe 100 and let's say 50 fiat dollars. So yes, I heard that Rick Rule is selling some of his physical silver, but he's going to buy silver miners. So, and in that sense, I agree, because the silver miners are heavily undervalued versus silver. And I'm sure Rick Rule has a lot of physical silver, so it's not like he's going to get rid of all of it. But for us smaller investors, yeah, I would hold on to my silver unless there's an emergency. And I would also continue to stack as much as possible, because I hear that the U.S. Mint as well is limiting the supply that it mints of silver coins, and other mints as well around the world. So I don't think it's going to get better.
Mario Innecco says the precious metals bull market is just starting. Massive debt, derivatives, and manipulated CPI make real rate hikes impossible. Silver trades near $100 in Asia versus $90 in the West, showing physical shortages. He advises holding metals, DCA, avoiding leverage, and not selling for fiat. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
China and India, they're buying a lot of physical silver. Also the Gulf Cooperation countries, which is like Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait. They had a deal with China back in December of 2022 to cooperate in building their infrastructure, and it even mentions photovoltaics, which is for solar panels. So yeah, all these countries are buying a huge amount of physical silver. In the West, the LBMA and COMEX is more of a paper market, and I think that's why the price of physical silver in Shanghai is higher than the Western prices, because it's for real physical silver. And that's why the Chinese as well, they've put export controls since the 1st of January this year on exports of silver. And yeah, I think it's about $10 premium over in China. And then you can also, I mean, when you take delivery in China, you pay VAT. But Eric Young, who's also known as King Kong, he does a very good job of differentiating the price with VAT and the price without VAT. And even without VAT, I think silver's trading around $100. I think today it's selling about 101 on the Shanghai Gold Exchange. So that's why it's happening. It's because it's a real physical market in the Middle East and the Far East and in India, while here in the West, it's still kind of a hybrid, but eventually I think there's no way that the price in London and New York won't catch up to the price in China or even India. I think there's a 17% premium. I think for Wall Street, and I've read about this, a lot of the major players on Wall Street, from banks, fund managers, they say it's a dangerous situation, because it, how can I say, it affects, it chips away at the Fed's independence to set rates as they're supposed to contain inflation. Even though, Elijah, I think the Fed is an inflation machine, but the majority of people in the markets and on Wall Street think otherwise. But that's a different topic. So yeah, it's seen as infringement on the Fed's independence, and people worry that if Trump or the DOJ really goes after Powell, it gives a really dangerous signal in the future. It's not totally just about Powell, is about the next Fed chairman or chairwoman. They would be thinking twice before doing something radical to perform, the objectives that they should follow from Congress of maintaining price stability and full employment. So yeah, it's a danger, and I think it's one of the reasons why. I mean, not the sole reason, because gold and silver were doing well anyway prior to the announcement from the DOJ. Yeah, and I know Trump has been pressuring Powell, but he's kind of left him alone right now. And but even if we didn't have this attack on the Fed by Trump, I don't think the fundamentals for gold and silver or precious metals in general would change, because the underlying problem we have is too much debt, and that debt can only be serviced and sustained by even more debt being issued, or more reserves or money being printed by the Fed, and more borrowing done by the U.S. Treasury, by the U.S. government. So I don't think fiscal policy and monetary policy are going to go tight anytime soon. In 1980, the derivatives market was minuscule, so there wasn't that hanging over the market. The national debt to GDP was about 35%. So Volcker could afford to let rates go up to 20%, short-term rates. I think the discount rate went up to 20%. And yes, it created a double-dip recession. There was a bad recession in 1980 and later on in 81. He was able to bring inflation under control, and that's when the bond bull market started, because the 10-year yield had risen to 15%, and in 1981, and what he did there was quite. People say, well, yeah, it was the right thing to do, and he did well doing that. But many people forget that actually Volcker was involved in telling Nixon to close the gold window. He was, I think, deputy. He worked for the Treasury high up when they decided to close the gold window on August 15th, 1971. So, and then he went to the New York Fed, and then he became chairman. So he was basically kind of cleaning up the consequence, the mess that came about as the consequence of closing the gold window as well. But yeah, right now, if you try to let interest rates go to 6-7%, to really bring down inflation, the whole thing would come crashing. The whole economy, the financial system, because of quadrillions in derivatives off balance sheet. And of course, the CPI these days, Elijah, it's been tinkered with so much that it really doesn't tell us what the debasement of the currency is. So we might even need rates that are double-digit rates. I mean, you've got John Williams from Shadow Stats who covers that. He looks at how CPI was calculated in 1980, and it is completely different than how it's calculated now. We have a danger of hyperinflation, and I think that's why, because there's no way that they can rein in the debt and contain inflation. If anything, they're going to keep fooling the public about what inflation is, and they're always going to find someone else to blame for it, like maybe Iran or China, but not the Fed, of course. I always think of trying to get as much of both with my fiat. So, but if people have a lot of silver and they've done really well and they don't have any gold and they want some exposure, why not? Get rid of some silver to get some gold. I don't have anything against that. But the other important thing about the gold-silver ratio is that you and I and others in this space have always been telling people that for you to have a real raging precious metals bull market, you need to see silver outperforming. And that's what we're getting. So this is, I think, in my opinion, just the beginning. And I don't know how long it's going to take. But if you look back to 1933 and 1980, when the credit cycle bottomed, the Dow gold ratio, 1933 was 2-to-1, 1980 was close to 1-to-1, and we're still just above 10-to-1, the Dow gold ratio. So I think there's still a lot of room in the precious metals bull market, especially relative to the stock market. The whole world, especially governments around the world, are realizing how important not just silver but all natural resources are, and how the supply chains are being disrupted because we're not in a multipolar world anymore. So I think the big guys, governments and central banks and sovereign wealth funds, they're going to have access to silver before retail. So yeah, I think retail needs to realize that if they're sitting on the fence waiting for a correction, I think that's a bad strategy. I think dollar cost averaging or exchanging fiat for real money whenever you can is the best strategy.
Your perspective on the continually raised margin requirements from the CME?
Well, I guess you could argue that it helps the bullion banks because they're mostly short. So if the price goes up, well, they will need more, I guess, margin, but also the longs. If the market goes their way, they will need more margin. But like you said, you're right. It's fair because the bullion banks are going to be losing more and they're going to have to pay more. So yeah, it would punish them more. You're right. And in the end of the day, we might see COMEX become almost a physical market if they keep raising the margins and the margins keep getting bigger. Yeah, but the other thing as well, I think an exchange, and I'm giving them some credit here, an exchange needs to make sure that it's not in danger of bringing down other counterparties in the exchange because of volatility. And I think that's why they raise the margins usually, because of the volatility in the market. I know there's a lot of silver in the world from past production, but it's in places that is really hard to get and recycle. But so right now, yeah, there's a desperate rush to get physical silver. There's a huge shortage. We've seen the mining supplies not match the demand for the last 5-6 years. And that's why I think the price of silver needs to go up at multiples in order for people who have silver to get rid of it, so that people that need the silver can get some.